Theo, the semiconductor index jumped 5.45% today, which is the kind of move that immediately grabs your attention. And here's the interesting part. The major infrastructure and software earnings have not even started yet. So what exactly did the market celebrate?
That is exactly the big question we have to answer today. If you look at Tuesday's action, it suggested the AI construction site remains highly active. We are still seeing the concrete being poured and the equipment arriving. The physical builds are going strong, and the capital continues to flow heavily into that base layer of the stack. But starting tomorrow, the incoming data tests a completely different proposition, whether that completed capacity is actually transitioning into an occupied, cash-generating business.
And that is the core distinction we want to explore today. The upfront cost of building capacity versus the free cash flow required to sustain it. We are going to look at what was genuinely incremental, separate it from familiar evidence resurfacing, and name the data that would support or challenge our read.
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let's start with the closing numbers, because the major averages stabilized across the board. The Dow Jones Industrial Average added 0.74%, finishing the session at 52,224.64. The S&P 500 gained 0.89% to close at 7,509.20. The Nasdaq Composite led the broader indices, finishing higher by 1.29% to 25,837.21, and the Russell 2000 advanced 1.53% to 2,987.40.
We also saw the VIX decline by 8.58% to settle at 17.05. That kind of volatility compression is consistent with less immediate hedging pressure, especially compared with the tension we saw late last week.
Right, and when that near-term pressure finally eases up, it often corresponds with a stabilization in the broader indices. But when you look closely at how Tuesday's gains were distributed, the participation was really concentrated in a few very specific areas.
Exactly. The surface tension clearly lessened, which is a relief for the broader market. But the underlying composition of the advance tells us a lot about where capital is choosing to park ahead of the fundamental corporate updates we are expecting later this week.
The split between the different layers of technology was stark today. The SOXX advanced 5.45%, and the SMH rose 4.52%. The broader technology sector, XLK, gained 2.89%. Looking at the components, Micron added 12.17%, Lam Research rose 4.97%, and KLA Corp finished higher by 4.8%.
But when you look at the software side of the market, it painted a completely different picture today. The IGV software ETF actually declined 1.25%, and the communications sector, XLC, retreated 0.69%. Within those groups, ServiceNow finished lower by 2.52%. Alphabet slipped 1.47%, and Alibaba gave back 1.97%.
So I have to ask, why did the hardware providers surge today while the application companies, the ones actually paying the bills for all that hardware, lagged so far behind?
It looks like the market is pricing the hardware cycle differently than the software cycle right now. There is a very clear bid for the companies supplying the base compute, alongside real hesitation about whether application developers can generate enough value to justify what they are spending. Just for context elsewhere, Coinbase advanced 9.61%, and the biotech ETF, XBI, added 2.36%, while consumer staples, the XLP, declined 0.94%.
Looking globally, the overnight sessions in Asia showed a similar risk appetite early on. Japan's Nikkei advanced 3.26%, and the South Korean Kospi rose 3.56%. The Shanghai Composite added 2.66%, while the Hang Seng was roughly flat for the session.
Moving into the European trading session, the action was a bit more moderate, but still generally positive across the board. The STOXX 600 advanced 0.56%. The DAX in Germany gained 0.66%. And the FTSE in London rose 0.58%.
And over in the cryptocurrency markets, Bitcoin traded higher by about 1.7%, hovering near $66,300 as risk appetite broadened out slightly.
Taken together, The global indices and the crypto moves offer parallel confirmation of the day's specific risk profile. The easing of pressure in the Asian semiconductor hubs occurred right alongside the bid in domestic infrastructure, which gave us a fairly consistent global picture for the stabilization we saw today.
But here is the interesting part. When we look at the trading volume behind the rally, it warrants some real caution. In a broad AI infrastructure basket, about 88% of the components rose, with an average move of positive 5.6%. Yet only about 15% of those constituents traded above their average daily volume.
The index-level volume supports that cautious reading. The S&P 500 traded at just 0.52 times its 20-day average. The Nasdaq was at 0.76 times, and the SOXX traded at 0.95 times average volume. After a difficult stretch, an advance on light participation can reflect sellers stepping back before committed. Long-term buyers have fully returned.
I keep coming back to the 5-day damage, which is still largely intact despite the green on the screen today. Over a 5-day window, Synopsys and Cadence are lower by around 8.5%. Lam Research is down 7%, KLA is down 5.6%, and Applied Materials has declined 5.2% over that same period.
Plus, the leverage in the Korean markets has eased but is not fully cleared. Taking the light volume and the lingering 5-day structure together, we would describe Tuesday as a credible floor attempt, not yet institutional confirmation of a persistent new trend.
But low volume does not automatically make the rebound meaningless, right? Sometimes the first change is simply that forced sellers stop appearing every hour. The market can stabilize before a new group of long-term buyers is ready to step in.
Exactly. That is why we are calling it a floor attempt rather than dismissing it. The next evidence is follow-through. Quieter trading in Korea, higher lows in the damaged equipment names, and stronger participation after the earnings reports. One green session can mark a change in pressure without yet proving a durable trend.
So that leaves us with an important question. What was genuinely incremental on Tuesday? The answer appears to be less than the size of the move suggested. Several data points discussed during the session were familiar evidence resurfacing from earlier dates.
For instance, we saw internal metrics circulating again about Meta's projected power needs. 7 gigawatts in 2026, 14 gigawatts in 2027, and up to $145 billion in infrastructure spending. But Reuters actually first published that on July 9th. It is great context for the overall demand environment, but it was not incremental news today.
NVIDIA's disclosed 9.3% beneficial ownership in Navius followed a similar timeline. It primarily reflects the $2 billion investment and pre-funded warrant announced in March.
And then there was the $1.7 billion financing package involving Bloom Energy, IDF, and Oaktree. That was formally announced on July 16th. Financing a deployment first detailed in May. It is a highly relevant example of project financing, but it does not represent a new customer materializing today. The true, fundamentally fresh data that we needed to see actually arrived after the closing bell.
Right, exactly. Once the regular session ended and the closing bell rang, Supermicro issued a preliminary business update for its fourth quarter. They estimated revenue near the low end of their $11.0 to $12.5 billion guidance range, which is notable on its own.
But the detail that really stood out was their GAAP and non-GAAP gross margin estimate of 15 to 17%, which is well above their prior 8.2 to 8.4% guidance. They also disclosed more than $60 billion in new Q4 orders and a record backlog, though management specifically warned that some orders may not be firm and could be cancelable or delayed.
The after-hours reaction appeared to emphasize those margin estimates and the heavy order volume, with shares rising roughly 20%. We also received operating facts from Aehr Test Systems, which reported a silicon photonics customer win, record quarterly bookings, and an effective backlog above $100 million.
Their stock closed higher by 27.86% in the regular session. And just for a brief industrial counterpoint, 3M reported adjusted organic growth of 5.4% and an adjusted margin of 24.9%. They raised their 2026 adjusted EPS guidance to a range of $8.80 to $8.95, offering a solid look at operating efficiency entirely outside of the technology sector.
Let's take those data points and apply them to the framework we are using today. Think of the entire AI build-out process, like constructing a massive, state-of-the-art commercial property, a major apartment or office building right in the center of the city.
In that analogy, the silicon, the power equipment, and the data center racking are the concrete, the steel, and the heavy machinery. Looking at the current order books, this construction site is highly active, with structural work advancing across several parts of the supply chain.
But a busy construction site is very different from an occupied building. The capital being deployed right now essentially acts as the primary construction loan for the entire industry. It finances the creation of the physical capacity. The next necessary step is utilization, which is the equivalent of tenants actually moving into those finished spaces.
And the revenue generated by cloud providers, search platforms, and software vendors represents the rent. The fundamental question is whether that rent will cover the interest on the construction loan, the ongoing power costs, and the depreciation of the hardware. The construction phase is visible now. The upcoming earnings begin to clarify the occupancy phase.
Here is the natural objection, though. If the tenants have not fully moved in, why are the order books already so large? Does the backlog itself tell us that occupancy is coming?
It tells us customers expect it to come, but the timing matters. Data center capacity arrives in large blocks, while workloads and paying users ramp more gradually. A backlog can therefore be genuine without being the same thing as current utilization. The constructive version is that the gap narrows as capacity fills. The risk is that the gap stays wide for too long.
We can see that construction loan phase in the financing structure is taking shape now. The Nebius and Bloom Energy deployment is one example. In May, Nebius selected Bloom for a 328-megawatt initial behind-the-meter fuel cell deployment.
The financing for that project, which was the July 16th announcement we mentioned, is a $1.7 billion investment. The capital stack has IDF as the lead developer, Oaktree holding minority equity, MUFG providing senior debt, and Morgan Stanley acting as tax equity and placement agent. Existing IDF and Bloom projects now exceed $2.6 billion.
The exact megawatts covered by this financing arrangement and the exact revenue contribution flowing to Bloom were not detailed in the releases. What it does show is that institutional participants can assemble a capital stack for large-scale power requirements.
It distributes risk and supports the physical deployment of power. But the economic return of that chain still depends on data center utilization and the operating health of the customer base. Financing by itself is neither a bull case nor a bear case. The useful questions are who has recourse, what milestones release capital, and who absorbs the cost if deployment or utilization runs behind schedule.
That question of risk allocation is also playing out at the regulatory level. The Wisconsin Public Service Commission recently maintained a rule that could require Oracle to provide more than $7 billion in financial guarantees or a letter of credit.
This is tied directly to utility generation and transmission infrastructure plans specifically for Oracle's proposed roughly 1 gigawatt Port Washington data center. The collateral trigger applies if Oracle's credit rating drops below A-. Oracle's rating was BBB at the time of the review.
To be clear, this is a collateral and guarantee requirement rather than an immediate $7 billion cash outlay. The rule is designed to protect local utility ratepayers if the data center project is withdrawn or does not reach completion.
It is a clear example of how infrastructure risk is being negotiated today. As power demands increase, regulatory bodies are ensuring that the balance sheet of the technology provider supports the localized infrastructure costs, keeping the stranded asset risk away from regional utility networks.
Moving from the physical buildup to the application layer, the software sector's performance today highlights a different challenge. The IGV's 1.25% decline suggests the market is evaluating the transition from infrastructure to end-user applications very carefully.
The idea that software companies will seamlessly monetize these new capabilities is an operating hypothesis, not a certainty. Infrastructure and security vendors might recognize revenue earlier in the cycle. Application vendors, on the other hand, have to demonstrate that their AI feature attach rates exceed the ongoing costs of model inference and API usage, all while preserving their margins.
Policy variables are also intersecting with these software economics. Treasury Secretary Scott Bessent noted the U.S. would investigate alleged model distillation and intellectual property theft, indicating the U.S. could sanction overseas companies if theft is established.
Just to be completely clear on the timeline, No new sanctions or specific AI procurement rules were actually enacted on July 21st. Analytically, if such restrictions did develop, they could protect the pricing structure for frontier API providers in the US. Conversely, they could also raise input costs for application developers and potentially fragment the operating environment.
Tomorrow's earnings will provide the next layer of evidence for our framework, starting with GE Vernova before the open. This report gives us real visibility into the physical power requirements of the infrastructure build.
We will look at their electrification and gas segments to see how existing order backlogs are converting into recognized revenue. Long-term commitments are one part of the picture. Current operating results show how the physical supply chain is executing.
We will also compare segment margins and free cash flow. Together, those figures show how order volume is translating into operating efficiency and cash generation. After the close on Wednesday, Alphabet will serve as one of the clearest public tests of the utilization and occupancy framework. Let's look at their Q1 baseline. They provided 2026 Capex guidance of $180 billion to $190 billion, with expectations for 2027 Capex to rise from there.
In that Q1 period, their actual Capex was $35.7 billion, while free cash flow was $10.1 billion, which was a year-over-year decline of about 47%. Looking at the revenue side of the equation, cloud generated $20.0 billion, growing 63%, with a 32.9% operating margin and a $462 billion backlog. Search advertising grew 19%.
Here is the natural question. If they're spending that heavily on infrastructure, does the revenue support the cost? We will be analyzing cloud utilization rates, the stability of those margins, and the resulting free cash flow.
If capital expenditures continue scaling higher without a corresponding improvement in cash conversion, it weakens the productive middle of our framework. But improving utilization, expanding margins, and stabilizing cash flow would support the thesis that the capacity is being efficiently occupied.
The rest of the Wednesday after-hours stack tests other specific segments. ServiceNow will report with a baseline constant currency remaining performance obligations, or CRPO, expectation near 19.5%. We are watching very closely to see if their AI-related annual contract value can successfully integrate underlying compute costs without degrading overall profitability.
IBM also reports their numbers after the close on Wednesday. We will check whether the mainframe deals that slipped in prior quarters have actually closed. That specific detail helps us test if their organic software and Red Hat growth remained intact while the mainframe deal timing improved.
Finally, we have to mention that Tesla will provide a very distinct read on industrial manufacturing separate from the data center build. We will be evaluating their automotive gross margins, their specific capital expenditures, and their free cash flow metrics. Zooming out to the broader macro environment, the equity rebound happened alongside strength in commodities. As of Tuesday's close, no U.S.-Iran ceasefire had been accepted.
The physical disruption remained unresolved. The U.S. conducted fresh strikes. A tanker crew abandoned ship following an attack in the Strait of Hormuz, and the Houthis stated a maritime embargo threat against Saudi-linked shipping.
And the commodity pricing we saw at the close really reflects that ongoing reality. WTI crude oil traded near $84 to $85, up roughly 2%. Gold traded near $4,080, also advancing around 2%. The U.S. dollar index was near 101.2, and the 10-year Treasury yield operated near 4.63%.
Different asset classes can weight different horizons. Equities and volatility metrics may be factoring in the possibility of diplomatic progress, while oil and gold are also pricing immediate physical delivery risks.
To wrap up our discussion, what would make us more constructive on the framework we discussed today? And what evidence would actually weaken it? We want to follow the evidence closely as it comes in and let the actual operating data guide our read of the situation.
The framework would weaken if this low-volume rebound fails to hold, if leverage stress in Korea resumes, or if GE Vernova's backlog does not convert efficiently into margins and free cash flow.
Further, if Alphabet's capital expenditures rise without a corresponding improvement in cash conversion, or if ServiceNow's AI attach rates fail to protect their operating margins, the occupied building phase of our analogy looks less secure.
What would make us more constructive is seeing the opposite: stabilizing infrastructure costs, expanding cloud margins, and software attach rates that generate solid free cash flow.
One general risk principle still applies. A correct long-term thesis can produce a poor investment outcome if its structure or leverage cannot withstand the volatility along the way.
Tomorrow's earnings supply the next major set of facts, and we are completely open to the data shifting our current read. One reporting day will not settle a multi-year build, but it can tell us whether the distance between construction and occupancy is beginning to narrow.
We will be watching all of those reports carefully, and we will review that new evidence together when we return tomorrow. Thank you, as always, for taking the time to join us today on The Working Thesis. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.